Everyone thinks the next collapse will look like 2008. Loud, sudden, chaotic. But what if the real collapse is already happening quietly, behind closed doors, while Wall Street smiles on TV? Because when one of the most powerful financial institutions on earth quietly unloads hundreds of billions of dollars in US bonds, that's not panic. That's preparation. And Goldman Sachs didn't just make a small move. They made a move so big that most people still don't understand what it signals. Today, we're going to break down why Goldman Sachs just sold $847 billion in US bonds, what they might be seeing that the public isn't, and what kind of economic storm they're positioning themselves for right now. T's move didn't. T happened by accident. Before we go deeper, make sure you like this video and subscribe to Market Truth Archives. We break down the moves Wall Street makes before the headlines catch up. If you want to understand the system instead of being surprised by it, you're in the right place. Now, let's slow this down and really understand what's going on. US bonds are supposed to be the safest asset in the world. They're the backbone of the global financial system. Banks hold them. Pension funds depend on them. Governments rely on them. When confidence is high, institutions buy bonds. When confidence cracks, they sell. And when someone like Goldman Sachs sells on this scale, it's not random, and it's definitely not emotional. $847 billion isn't a hedge. It's a statement. To understand the warning here, you have to understand how bonds actually work. When interest rates go up, bond prices go down. Over the last few years, the Federal Reserve has raised rates at one of the fastest paces in modern history. That alone has crushed bond values. But here's the part most people miss. Big institutions don't wait for damage to show up on balance sheets. They move early. They move quietly. And they move while the public is still being told that everything is stable. Goldman Sachs has access to data most people never see. Corporate defaults, liquidity. Stress, Treasury market depth. Foreign demand for U.S. debt. When they shift away from bonds this aggressively, it suggests they believe rates will stay higher for longer. Or worse, that something will break under the pressure. And cracks are already forming. The U.S. government is issuing more debt than ever before, just to keep things running. At the same time, foreign buyers like China and Japan have been steadily reducing their exposure to U.S. treasuries. That means fewer natural buyers. More supply. Higher yields, just to attract demand. That's a dangerous cycle, because higher yields mean higher interest payments. And higher interest payments mean even more debt issuance. It feeds on itself. Now imagine you, Ray Goldman Sachs, watching this in real time. You see a government drowning in debt, a Federal Reserve trapped between inflation and recession, a bond market that's losing its role as the world's safe haven, and an economy that's slowing under the surface, even if the headlines say otherwise. Would you sit still, or would you quietly reposition before the crowd realizes what's happening? This is where the story gets uncomfortable. Wall Street doesn't warn Main Street, it exits first. In 2007, the biggest banks were dumping risk while telling the public everything was fine. In 2020, insiders sold before the crash hit the news. The pattern is always the same. By the time regular investors react, the smart money has already moved. Selling bonds on this scale suggests Goldman Sachs is preparing for a prolonged instability, not a quick crash and recovery, but an environment where volatility is normal. Liquidity dries up fast. And traditional safe assets don't protect capital the way people expect. And here's the part that really matters for everyday people. If bonds are no longer safe, pensions suffer. Retirement funds suffer. Insurance companies feel pressure. Governments face higher borrowing costs that eventually flows down to taxes, services, and cost of living. This isn't just a Wall Street chess move. It's a signal that the foundation itself is under stress. At Market Truth Archives, we don't believe in panic. We believe in pattern recognition. And this pattern is familiar. Late cycle behavior. defensive positioning, quiet exits, public optimism masking private concern. You might be wondering why this isn't all over the news. Because complex financial risks don't trend well. Fear sells when it's obvious, not when it's subtle. And institutions prefer it that way. The less attention, the smoother the exit. But markets don't collapse in one day. They erode. Confidence fades. Liquidity disappears. Then one event pulls the thread, and suddenly everyone is asking how it happened so fast. Goldman Sachs doesn't need to predict the exact trigger. They just need to know the system is fragile. And fragility is enough to justify moving hundreds of billions out of assets that used to be considered untouchable. This doesn't mean tomorrow's a disaster. It means the risk-reward balance has shifted. It means the old rules aren't working the way they used to. And it means the smartest players are preparing for a world where stability is no longer guaranteed. Ask yourself this. If everything was truly fine, would one of the most powerful financial institutions on Earth be repositioning this aggressively? That's the question most people aren't asking yet. And it's the one that matters most. If you've made it this far, I want you to comment below and tell me what you think this move really signals. Is it smart risk management or a quiet warning? And if you found this breakdown valuable, share this video with someone who still believes the system can't fail. Conversations like this are exactly why Market Truth Archives exists. Stay alert, stay curious, and remember, the biggest financial shifts usually happen when most people aren't paying attention.